It is Thursday, October 3rd, and this is our Insider Access briefing. Now, some of this, the early portion is going to be made available and free to the public, so we're going to have some analysis, going to get into the S&P 500, SPY, QQQ, we're going to look at Meta, Nvidia, and then we have a jam-packed video insiders. We're going to go deeper analysis on Nvidia along with some trading levels, which have been absolutely fantastic for us as of late, and look at some other securities as well. Tesla is on deck, small caps, Apple, Amazon, and so on and so forth. But let's just get right into it here. Okay, so we know that I'm not a zealot here when it comes to technical analysis. We held in range, and generally that is what I noted out to insiders today within Discord. I said, look, this is going to be a range-bound day. It's going to be very general to what we've seen in the last few days on the S&P 500. Now, that doesn't mean that without the right conditions, you can't absolutely nail a trade. And for us, it was 56.80 on the S&P 500 yesterday. To take that as a trade, absolutely caught fire on that level, and that really held well today. And that was something that we discussed yesterday. Now, you don't trade. We weren't trading the S&P 500 on the SPX, but we were trading on the SPY, right? And what it equated to in the general was about 565.25. And something I'll note to everybody, insiders know this: just be careful when you're equating the S&P 500 SPX to SPY. It doesn't always correlate perfectly, although they are relatively close. But how did that work out? 565.25. Hit perfectly. That would have hit perfectly yesterday and made an enormous move. So that's for intraday trading. And then today wouldn't have quite hit, but if you actually look at what we were working with, instead of going straight to the SPY, just 56.80. Absolute perfect. Absolute perfect. So what are we seeing here for the S&P 500? Well, we're going to get into some analysis as it pertains to non-farm jobs and some other reports. But our other idea, and this is from yesterday, we recapped this yesterday, insiders, just to kind of go back on it and show the public what we've been doing with some of our work, was 478.40, right? This was our trend line, and it was more than just a trend line. There's a reason we felt that the markets would hold. So the idea of just, there's a line on a page and it happens to create a shape and therefore price action will adhere to it. No, we were getting data all throughout the week, which I'm about to get into because that's the most important part. If you want to lose your money quickly, fall in love with lines on a page and then pull your hair out when it doesn't obey that and don't understand the general market conditions, don't understand anything you're doing, just, call for the next level. What's the level? What's the price? If you actually understand what you're doing, then you're going to be somebody that succeeds in the long term. And I've seen countless people come and go in the trading world and burn out, even professionals that thought they want to be part of the markets, and then they really struggled. So 478.40, absolute perfect yesterday. Didn't quite touch down today, right? So those are the precise prices on the indexes. That's what we've been doing, some of the work we've been doing. Now let's get into why and what we're looking at and why I was confident we'd stay in range. Really, there wasn't a big shakeup in terms of data today. In fact, the data came in perfectly. And if we were looking at the data, what is the data? Initial jobless claims. So what did we get? Initial jobless claims moved up a little bit, about 6,000. But the 4-week moving average came down. So they sort of offset, and ultimately they're in the perfect range. So why is this important? Because we were hyper fixated on inflation for the longest period of time, and that was important to see that inflation was coming down, and that would support the Fed's cutting. The Feds are now in a cutting cycle, and they're catching up, and my projections on that were absolutely dead on. I said they would ultimately fall behind, raise more aggressively than they initially intended to, or raise more frequently. What is the focus now? It's not a hyperfixation on inflation. What the markets want to see now is that we're not heading towards a crash. That's why in August, when it seemed like non-farm jobs were very low, the markets went nuts and we saw a big crash, and it was an erroneous report because they hadn't factored in some of the state level data, and that's something that insiders knew in advance. Here, this is perfect. This is the Goldilocks zone. It's not too hot. We didn't have a phenomenal report where jobless claims are extremely low, and it's not too cold to where we're saying, okay, crash. Because you don't want to get so hot that you feel like we're reigniting inflation, the economy's heating up too much. You don't want to go too low because that says we've overshot, there's going to be a crash. And to take a look back for those who are interested, what we saw in August, this was the drop in August. I just drew this trend line later. This was September, and we kind of had the same view. In August, I explained to insiders, and we had the inside track because I looked at the state level data from Texas in particular, and I was able to explain to insiders that the non-farm jobs report was erroneous, and the markets would correct. Why? Because they hadn't properly factored the damage from the hurricane and the jobless claims that spiked. There were over 2 million people who were left powerless. So of course that's going to factor. And when the non-farm jobs report was released, the data was included, and so we had a weaker turnout, but they hadn't quite explained that was the factor, so the markets panicked. And of course, further data came in to support the notion that, hey, this was a bit of an erroneous report, and we expect that coming into tomorrow. So coming into tomorrow for non-farm jobs, how do we expect it to play out, and how is the market going to work? Well, let's take a look at a few things. So earlier in this week, started off with JOLTS. JOLTS number was good, right? JOLTS number at 8.04 million. That's good. That's right in line with what the markets are looking for. That sits in the Goldilocks zone. What else have we gotten? We just got ADP data, and the ADP data looks pretty good as well. The average rose a little bit. We went from a dip from what we saw in the past couple months. It looks like a bit of an inflection point, but this isn't so high that we feel the economy is overheating. And then we also saw an inflection point. This is on today's data, right? Because you can take a look at the important data that's out there. Don't put your head in the sand if you want to be a market participant and if you want to excel. Treat it like you're a professional, even if you're not. That's what I always say. Because the idea is you're dealing with your money. So you should be treating this as professionally as possible. It shouldn't be, I kind of dialed it in and took a guess and crossed my fingers. Don't invest, right? Treat it as a professional. You could find good professionals who have proven track records. And that's part of why I explain myself and I'm so detailed in my ideas, because I hate this idea of flip a coin and guess. Oh, you're right. Oh, bro had a banger and or whatever, whatever slang people apply to it. The lit banger was lit. Whatever, great trade idea. I'm not very good with slang. That's nonsense. Explain it, qualify in depth. And it shouldn't just be, well, there's a line here. And if you see these are all peaks around that line, therefore that line should make you money, right? Here's what we saw. We saw an inflection point, combined technical with the fundamental. So this is good. What we saw in ISM services, it's good. We saw an inflection point. There was a concern. We were into contraction, right? We don't want to see this absolutely take off and get too hot. But getting back to somewhat of a median, right? Getting back to where we were back in December of 23, that's not a bad thing. And I think that's supportive of the market. So everything, when you look at the JOLTS data, the jobs week, and actually, again, the smoothing average, the 4-week moving average coming down a little bit, but jobs coming up. If there's someone writing this data, and I know there's a lot of people who believe there's manipulation, I'm not saying there is, but if there was, they're carving this out to appear perfect right now, because all of the data seems to support the notion of a soft landing. And what I've said is I think that's going to be what we see for at least a period of time. And then we'll see where we are in 2025. I believe there's a lot of factors that come into play. So tomorrow, what are we looking for? We're looking for 150, which is a revision up. And I said the markets would expect higher. And that proves that August was anomalous. Prior was 142. So the markets are expecting more. If we get in range with that, and as long as we don't show the markets are melting down, I think that's going to be bullish. And the last point that I'll put on the macro markets here for everybody to understand so that you can support your trade ideas is this is something that I explained to insiders earlier in the week as well. I said, look, on the sell-offs of fear and the panic for the dock workers strike, this will come to an end. And I didn't say that sort of haphazardly where you're not sure, which is analysts drive me crazy because they love to say that. They love to say, well, we could see, but maybe we won't, but we don't know. But if it's right, I will take credit. And if it's wrong, I'll say that I used some special wording so as to cover myself. I said, there's absolutely no way this will linger. We have an upcoming election, and we're not getting political as to take the side of Team Blue or Team Red. It doesn't matter what team you're on or what administration. So you can't just say, oh, the Biden administration or the Trump administration. Any administration coming up to an election period would not want to go in with dock workers on strike for multiple weeks because it compounds week over week and supply chains will get jammed up. The shelves will start to see lower inventory. That is a death knell for any political campaign. I would fly to the table to make a deal. So well played, strike suspended, massive raise, 39 an hour, moving up to 63 an hour over the next 6 years. Huge win, and they played their hand very strategically. Regardless of what you think about this, this is one of the items where if you understand the markets well, you'll have an opportunity to take advantage. Now, did I know exactly which day they're going to come to a deal on? No, they could have come to a deal yesterday, but I knew it wouldn't last very long because there's just no way, right? There is just no way you will allow this. It's essentially, look at this as the entire election, okay? Are you willing to give away the entire election as whatever administration? Again, it's not about Republican or Democrat. Whoever's in charge, this happens under your watch going into the elections, yeah, the other team wins by a long shot, right? Give yourself a fighting chance. Put the pressure on. See which phone calls you can make. Get people come to the table, and help facilitate having this happen. So that's what we felt. Calls were made, negotiations were in place, and that's what we're seeing here. So going into tomorrow, Now, this is just a little bit of a bonus, and I was going to include this towards the end, but some insiders who are working with sensitive securities related, let's take a look here, okay? So we're going to move over from the SPX so we can see some futures on the SPY. And SPY is up modestly, right, in the after hours. But more important, if you look at a couple of the names that are sensitive to that deal, Amazon, what do we got on Amazon? Amazon's already on the run. I would think Apple here is a name that is somewhat sensitive. Yeah. Apple's also on the run. Here's my view on that. If you're trading these names and you're working with weekly expirations, yes, non-farm jobs is likely going to have an impact, but like I said, this isn't like inflation where you need an exact number, or like it was over the last few years where we're really, really being precise. With non-farm jobs, here's the projections, right? 150, as long as we come in somewhere 150, 155, 160, 148, at a decent number. The idea is just not to overshoot such that we show the economy's catching fire, which I really don't expect, and not to undershoot to the point where we believe, oh no, this could indicate an oncoming recession. So it's more of a general area now instead of scrutinizing exact numbers. I think that'll be supportive of the markets, at least in the coming days. Whether we react perfectly tomorrow in the coming days, I think that's very supportive. Now, if you have one of these positions that's run in the after hours, my idea would be this. Watch the opening bids on your contracts, particularly if you're working with options and it's a weekly expiration. Take a look, because expect an IV spike. And so it's a consideration. One, if you're on the last day of a weekly, your theta is ticking against you. So by the end of the day, if you're out of the money, at the expiration, you're going to run to zero. But either way, theta is aggressively taking off your extrinsic premium, even if you're in the money options contracts. So watch for the open. If you get a hard burst into the open, right, consider. One of the strategies you could use is you can exit if you feel the IV is red hot. So if we run really hot in the after hours and this continues into the AM, you're going to have a really pumped up IV, right? And so IV means like when you open, if that calms down and price goes sideways, you could see a substantial drop. Now, another idea would be just set a trailing stop, right? Start following it up. Start following up if you feel that it's going to continue to run. And perhaps that's the strategy here, because if we look at Amazon, it's given up quite a bit in the last few days, and there's some impact clearly as a result of the strike and concerns. So if you recover a little bit, I would say there's certainly room to run, but it doesn't mean that happens tomorrow. So strategically, I move and I start following that with a trailing stop if that's something that you're trading, and the same applies to Apple. Let's get to Nvidia. So Nvidia, some cool trading on Nvidia. And AMD was a public trade idea today, and let's just get in on a lower time frame. AMD was a public trade idea today, and Nvidia was an insider's trade idea. So let's take a look at Nvidia. What do we have here? So we looked at 121.55, but not only that, I'm going to move to the 1 minute chart here. We actually noted specifically, not only was 121.55 our level, but specifically that we felt we would have some struggle, some consolidation, some rejection. We'd struggle at 121.55, and then we get a subsequent breakthrough. So I said, first we struggle at that level, and then we get a subsequent breakthrough. And that was direct to insiders, and made this little graph after. And I quoted the trade. This was early in the morning. Said, this is from the idea we circulated. Then we're up 100%. I said, early struggles at 121.55, then subsequently breaks out. Early struggles, subsequent breakout, right? I don't even need that chart. Early struggles, subsequent breakout. So I want to move on from Nvidia, and insiders will be back to look at Nvidia in more depth later on in this video. I just want to jump over really quickly to the VIX for everybody to see this, and something to keep an eye on. The VIX indicating market concerns, right? There's a lot of geopolitical items. Generally, the markets tend to see over 20 as being a period of risk, right? There's no exact number where it's risk on, risk off, but generally over 20 is viewed as a risk area. Recently, due to the spikes, I think 2150 is a bit of a red flag. The VIX has been elevated, right? So we're working at 2049, which was the last price that we have here. The markets are a little bit concerned. I think the dock worker strike will help lower the temperature here, but then we also have some volatility in the background, of course. A variety of geopolitical items. I don't think the Carolinas hurricane is impacting the VIX anymore. I think the thing to keep an eye on with that is the conflict in the Middle East. And as we see the conflict rev up, particularly if there's going to be strikes in oil fields and all that sort of thing, you're going to see the VIX elevate. So there's a little bit of concern from the markets, but I think part of that as well is just a little bit of concern coming into Friday. And I think there's room for this to clear and start to settle down, but it's not necessarily an area or a reason to avoid the markets. Last one that we're going to run publicly. Meta. how often do we come back to pat ourselves on the back for this one? Meta was actually one of our ideas of the year, and this back in December was 354.07, and coming into the year we set the target as into 2024 we set the target for a year-end 600, and that seemed ludicrous when the price was lower. And even as Meta sold off and went down to 450, 67 touchdown here, we reiterated in August. I reiterated, and this is something that was very bullish on. And these are the things where you get that big sort of payoff. We said if it's 401k, if you're taking leaps, you're trading. I maintained the target of 600, and that was conviction, right? And that's also just performing the proper analysis. We were actually very bearish on Meta last year and got hyper bullish this year, and with very good reason. Meta's been on an absolute fire. We're now at the highest close on record, 6 points over the second highest close. Target $600 for the year, but strategically, as I said, now's the time you start adjusting stops up, right? Because if we get to 594 or even at 582.77, if we get a heavy reversal here, right, you don't lose all that you've gained. You don't even risk it. Strategically, you start to adjust your stops up, right? If whether it hits 600 or not to our exact target, and I would revisit, and potentially there are some revisions to be made on that target or not, this is an absolute win. It's right in that zone. Fantastic. Knock it out of the park. Take it home. Tell the network news they could run that. I didn't hear too many analysts giving that sort of price point here. But that's something we not only were bullish on, but we reiterated, even during the periods in which Meta pulled back. And that's because we made an extremely powerful fundamental case for Meta, all right, on a variety of factors. This wasn't, well, there's a trend line and the trend line will continue and never be broken. Okay, if that's true, Meta will be infinitely priced within a few years. No, Meta actually had a very poor year going back, right? So if we just go back to 21 into 22, Meta was bearish, and we were hyper bearish. And I explained why. I felt Meta was overstaffed. I felt that they were sinking money into the metaverse and not getting returns. The shareholders were getting frustrated with poor operational efficiency. You had executives leaving. I believe Sheryl Sandberg left. Mark Zuckerberg seemingly was obsessed with the metaverse and sinking money into that without a clear plan that he could articulate to shareholders. And we had a major pivot, at least fundamentally, got their house in order, started to shore up in terms of staffing, got leaner, more focused. He got some religion and started really focusing in on the things that matter and started to become a better player within the AI space, with like their ad space, variety of reasons. Okay, so patting ourselves on the back for Meta. I just wanted to re-articulate that strategy because I understand at this point, for those holding Meta long-term, insiders that have been with us, thank you for being an insider for so long. Even if it was just at the beginning of this year, or if you've been here for a couple of years, you enjoyed it when we hammered it on the bearish and on the bullish. Just want to articulate the strategy because I know it's exciting, but you want to stay focused and be able to get the most out of your trade. So insiders, stay tuned. We have much more coming up. We're going to delve into Tesla, talking about Meta, and we are going to talk about some trades that are specific to what's going on within the Middle East and how we can exploit again and take advantage to have probabilities weigh in on our odds. So much more to come.